Are you looking to get a funded trading account? I know nowadays there are a lot of options for you. But here at Trader Funding Program, we do things a little bit differently. Plus, we're run by a group of traders that have decades of experience on trading desks and trading floors from around the globe. And we have a simple set of guidelines for you to follow with no hidden rules. And plus, we give you tools to help you become successful, like using ForexAnalytix, like being in a community of traders where you get to talk to people like me and other ForexAnalytix analysts all throughout the day. If you take an assessment during the month of July 2024, you're going to get a one-on-one consultation with me, Blake Morrow, President of ForexAnalytix. So join us today. I look forward to speaking with you soon.
Good morning, everybody. Welcome to the Flow Show. It's Tuesday, 2nd of July. Here we are, second day of the second half of 2024, and got a bit of dollar buying going on. So it looks like we might have a little bit still some of these second half year moves coming into things at the moment. Just before we kick off, just want to bring you some news. We've got the Trader Funding Program up and running. Currently, there's a bit of a special offer on for you. If you take a trading funding account within this month, Blake is offering free time on our coaching. So you get a free session with Blake on our coaching. I've put the link to our trader funding program there. Check it out if you will. As I said, you get a free coaching session with Blake for anyone who takes an trader funding program account. So you can do that on that link there. A great offer there. Should keep Blake busy for the next few days, or for the next few months if he gets lots of sign ups. So take advantage of that one. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. Good morning, everybody. Yep, doing fine. We are already surviving the second day of the second half. So yeah, ready to rock and roll from now on. The week should get perhaps a bit more lively. Well, it's already been a bit lively, but even more lively with Powell this afternoon, perhaps.
Yeah, we've had lots of waffle from this Sintra business after the ECB Governing Council seems to have been out waffling already. So not looking forward to going through those lines, but look at them, we will. Right, let's kick off as we always do over in China. PBOC is back with its foot easing off the brake pedal, setting its midpoint at 7.1291, up from 7.1265. Seeing another bit of an uplift in dollar China. But again, this looks maybe more related to what's going on in the dollar today as opposed to anything going on in China. But it's going the right way. I'm not long anymore. I'm waiting for a dip back that hasn't happened as yet. I don't really want to chase it up here, but we're getting up towards the next sort of resistance levels that we've been shown for a while now, up towards this 731, 732 traffic zone up here. Keep an eye on that one. Over in Japan, Finance Minister Suzuki says the market has been driven by various factors, including sentiment and speculation, but didn't elaborate too much on what's going on in yen at the moment. Kanda worried about those rising yields absolutely rocketing. I'll say that with tongue in cheek, of course. He's been out saying we must be aware of a ratings downgrade risk as yields rise. Obviously, given how much of the market, over half the market, the Bank of Japan currently is sitting on, any big rise in yields will put financial pressure on Japan and the government and the Bank of Japan, obviously. So that's why he's warning about that. Speaking on the FX front, he says that FX moves show signs of speculative activity. So keeping that speculation line, dollar yen continuing to grind higher and higher and higher. Picking up a bit of speed, K perhaps, but I don't think we're in that 200-300 pips a session zone just yet.
No, we are not in this amplitude, but the more it grinds higher, the higher the risk becomes. I'd say for an intervention or so. But yeah, for the time being, they do not seem to want to stand too much in the way of it all. And let perhaps the market pan out, let those US data come out. There's very little they can do about the curve as well, with the yields sticking higher, the curve steepening. It's all yen adverse, right?
Yeah, very much, mate. Right, just one thing. We've got some guys in the Zoom chat at the moment. Welcome to the show. Anyone pumps anything other than what we're doing here, you want to pump some services, you're going to get kicked off first and foremost. So behave yourselves. You want to come in and watch the show, fine and dandy. You start pumping links and other stuff not related to us there and other services, you're going to get booted. Let me just make that nice and clear for you all. Right, cracking on with the rest of the news. The RBA minutes were out, and pretty much a rinse and repeat of the last several months of minutes and meetings or whatever. The board judged the case for holding rates steady, but thought it stronger. Sorry, let me get that right. Board judged the case for holding rates steady, stronger than for hiking. So keeping that rhetoric in play. However, there was what could be construed as a bit of a hawkish comment in the minutes as well. They said a material rise in inflation expectations could require significantly higher rates, not a return to hiking rates, but a significantly higher rates, which is a bit of a more hawkish tilt, shall we say. Over in the data, we had a bit of data out yesterday from Germany. The final, or not final numbers, but after the regional numbers, we got the main German CPI numbers coming in a little bit softer than expected, but round about what we saw marked in those regional numbers. So all well and good there. Eurozone CPI was out this morning, not down perhaps as much as some expected. The core remained unchanged, was expected to fall a pip to 2.9%. Headline CPI did come down to 2.5% as expected. So, as said yesterday, it keeps inflation on the sticky side regarding the ECB. We can obviously rule out a July hike. The bags will be getting packed and they'll have all their eyeballs on going on holiday, wherever that may be. So this July meeting is probably going to be a bit of a dull one when we get to it. Whether they set anything up for September, October, latter part of the year remains to be seen. But they will punt it to that forecast meeting, which will be in September. Right, let's get through it. All the ECB wafflers. ECB Simcus says 2 more cuts in 2024 is possible if the data comes out as expected. He agrees the case for an interest rate cut in July has gone. ECB's Wunsch says we would need convincing to cut more than twice this year. July is an option in theory, but in practice we must be cautious. ECB's Kazakhs. Inflation is to move sideways until late 2024. The market bets of 1 to 2 cuts is consistent with the baseline. I don't know if that's 1 to 2 cuts total or 1 to 2 more cuts. We shall see. ECB's Lane says we need a little bit of time to assess inflation. De Guindos, no predetermined rate path given the uncertainty. Muller, we can probably cut more if the baseline holds, but must be patient with further rate cuts. Centino, we must be prudent on rates. Vasley, rates can be cut further if things go as expected, but we need more data to confirm the inflation trajectory. And the suntan one herself, Lagarde, ECB needs time to assess inflation uncertainties and to be certain that inflation is on track. In the meantime, the market is pretty much going for 1 more cut this year, pricing in 25 pips of cuts for the rest of the year. That's probably round about right, I should think. Kay, I don't think there's any reason to go higher.
Unless we see other data rolling over. But for the time being, that's not happening, because at the same time this morning that we had the CPI, we had a very flat lining unemployment rate. So there's no real flags there starting to wave either. So yeah, I think we just have to go with what the market is really pricing right now. It's tough to have how shall I say, a completely different opinion than what the market is pricing in. Personally, I think there is a possibility that that they may have to do one more. That is what I think. But I'm rather on the same line than what I have in for the US, that we may see a bit of a surprise of an extra cut somewhere. But that, of course, that's the data that will show us. But I've got like half in mind that we may need to in the second half, as time progresses, that we are going to have, and they will have to revise their opinions too. So yeah, it's limit border calls for everything. So for the time being, as we always say, the market is right, and why fight it, huh?
Yeah, very much so. It doesn't bode well for volatility going into the summer, but you know, I'm sure politics will keep us on our toes throughout that period. So we hopefully should get some volatility coming in from that. Right, where am I? I'm over here. We are looking at some of the data from yesterday as well. Back to the US, and we got the ISM and the PMIs popping out. First of all, we had the final S&P Global Manufacturing PMI, which was a little bit down on the flash number, 51.6, but still higher than last month. The ISM was a bit of a wobbler. Headline PMI coming in softer than last month, was expected to rise, but not into contraction. It fell further into contraction. Prices paid came down more than expected, still remained positive though. Unemployment, that went into the negative. Now, that may be a bit of a bad sign, but if you look at the data historically over the last few months, the last time we were in expansion was back in October for the September number. So really, employment has been pretty weak in manufacturing. So this one is obviously, last month's May was obviously just a little bit of a blip. As you can see, you know, even then it was the first uptick for quite some time. So we know manufacturing sector globally has been in a bit of a slump. It's not a big makeup of the NFP. When you look at the manufacturing numbers in the NFP, you're talking 8,000, 6,000, 10,000 changes now and again. So it's not a big part. So don't extrapolate anything really from that over to the NFP, because all the months while these numbers have been in contraction, we've still seen decent positive numbers from the NFP. The services number from the ISM that we're going to get is going to be more important because that's obviously the bigger chunk of the NFP. So yeah, don't extrapolate anything from these numbers to NFP just yet. We've had a few Fed wafflers as well. Fed Williams is confident the Fed is on the path of getting inflation back to 2%. Fed's Goolsbeast says keeping rates restrictive for too long is a problem. A bit of political news, and this is playing into what we're seeing in markets at the moment. So yesterday, the Supreme Court ruled that Trump has immunity for official acts. This is all part of this case against him for the 6th January stuff that happened after the prior election. He's facing that trial there. So, but this Supreme Court ruling says he's got immunity for official acts, but it's been a bit of a punt on the trial. So the actual court case that's going to happen now has been punted past when the presidential elections are going to happen. So this Jan 6 trial won't go to trial before the election. So that gives him a bit of a pass. Biden's been up in arms about that, but what you can do, this is politics in the US. A lot of this market move, and I know Kay's picked this up as well, saying that what with the debate last week and worries about Biden and his health and his faculties, shall we say, some of this move and the court move is playing into what we're seeing today. Kay, you give the explanation.
Yeah. If we look back at what happened in 2016, take away the equity market for a while. This is sort of the reaction that we could get, and the reaction that some of Trump watchers and election watchers may have expected. So steepening curve, yields higher, deficits higher, but that would be valid for both sides, right? And so now, yeah, it looks as if the market wants to trade a bit of that, or is perhaps forced to trade a bit of that, because I don't think that anyone wants to really sell bonds, but it looks a little bit like a forced move on the back of it to what, well, for what I am concerned anyway. So that is what is trading now. I really thought it was all to do with end of month quarter and then the start of the new quarter, which is still very possible. And I also think that if you really look at what's may happen and you look even at a possible Trump election, it's not really the yields higher, okay, steepeners, okay. But then in 2016, the equity market started to shoot after a while. But I don't think we can all attribute it to that. So I still want to see for how long this is going to be traded. But if we look at a blueprint of what may happen if we get a Trump election, is sort of what's happening now in the bond market. And I trust for the majority, these are algo moves on the back of what's happening. Because if you see steepeners, they're traditionally not very good for the yen. Higher yields, even less. So yeah, this is what's happening in the market right now. So we really have to watch for how long this will last, because I do think that if we get a bit different numbers coming out, or Powell saying something different, that we may have a small different picture. But for the time being, and volumes aren't that big in the market, so it does seem that not a lot of people stand in front of a lot of those moves. So it could easily reverse as well. But in the meantime, if this continues to trade, I think there's going to be perhaps a bit more people forced out of positions, because we are on just ahead of a relatively important 4.5% there on the 10-year, trading 446s, and that's keeping the dollar big right now. Yeah, that's about what's going on in the market. But is it justified? I think time will tell. And as we have seen, the market can trade stuff for 48, 72 hours, and then all of a sudden forgets about it, and we are doing something completely different.
Yeah. We've been saying this. Last week was obviously a funky week. This week is just as funky week. Got plenty of data. Half of it's going to be lost to a US holiday. We're coming off the period. As you have firms closing up positions into the end of the half year, reopening them up in the new year. Maybe they're looking around and thinking, well, where are we going to park our money? Who's got the best economy? Who's got the best prospects? And once again, it's the US. If you take the first half performance of what's going on economically in Europe, and the US still outperforming, it could also just be a simple thing of flows going there and deciding that's where they're going to earn their money for the rest of the years. But yeah, it's a very funky week as usual. To coin our mate DKT in the chat room, don't trust anything at the moment. All you can do is trust your charts, trust your levels, trade your levels, and if they break, then maybe something's changing. If they hold, then we're staying well within ranges. Just looking at the calendar there, we've not got, apart from jolts, we've not got a lot of data out today. Lagarde is waffling again later. And we also get Powell as well. So we'll see if he's going to offer us any tidbits on current policy or the moves that we've seen since the FOMC. Could be a little bit of an update speech, shall we say, if he thinks the market's gone too far one way or the other way. You might want to do a little bit of shepherding on that. That's it, I think, from the news as far as I'm concerned. Kay, anything else crossed your radar?
Fresh news wise, not a lot. No, not a lot. Just people are trying to find reasons for oil going up, and that's apparently having to do with issues that refiners and people may have to in regards to the hurricane arriving in the US. So we've got to keep an eye on what's happening in oil there, because it could be once more weather related. Just watch the hurricane moves to know what's going on in oil and what may potentially be the next move there.
Yeah, that Category 4 storm mode on the radio has been upgraded to a Cat 5.
This is bigger. Cat 5 is a big one.
Yeah, the top banding. So if it moves across into the Gulf, across the refiners, that's what usually drives oil. Let's hope, more importantly, that there's no loss of life and everything's okay for people in its path. I was watching some of the satellite images from it yesterday, and it looks a real humdinger. So, yeah, check that out. Yeah, thanks, Patrick. That's what we're having a look at. So oil, yeah, keep an eye on that. It's not really, again, we're not seeing that much of a correlation between oil and dollar CAD at the moment. But before I move to dollar CAD, we'll just keep an eye on these oil moves that we're seeing here. Bit of a bust out. We've been in that sort of 80s, 82 range, and we've messed around there for a long time. So this is looking like a bit of a breakout above that 82.50. We've done it before. And we've held above it before for a while, before it's come back down again. If this thing passes by without much fuss, let's hope it does, we should probably see oil markets coming back off again. But I don't know if we're going to undo all of this, but be prepared for a little bit of a dip back if this thing peters out pretty quickly. As mentioned, it's not having a huge effect on dollar CAD. The dollar is seemingly taking, although we're still quite tight. It's not often you see dollar CAD sitting in a fairly tight range as it does now, but it's doing what it needs to do. If you're range trading this one, it's proving pretty good. I'm still long a little bit from down below, looking for a move up towards this 38s level. See if we get up there, maybe even towards those highs. I'll look to play the range, maybe flip it short, depending on what the dollar's doing. If the dollar's still looking very strong elsewhere, I might hold off and just keep the long and see how far it wants to go. But if we're going to run into trouble, nearby 137, 70s, 80s, and then into 138s is where you're going to be looking. Main support still remains down at 136.50, and then even bigger 136s. Just keep an eye on this line in the middle. Big figure 137, a move down there and a hold will keep this move alive, this short-term move alive. Anyway, euro dollar is having a little bit of a washout. All that election stuff seemingly well in the rearview mirror now. For those who like it, gap was closed yesterday, and we're moving further down now. One thing I just wanted to highlight on the longer term charts, this is where you need to do a little bit of zooming out and a bit. Just keep an eye on this 100 weekly moving average here, 100-day weekly moving average here. It's been underpinning us pretty much all year. Okay, we can't get and close below it. We can't, let's zoom in a bit more, and we can't have a week below it either. So that's coming in right on that 106 60s area, 50s, 60s area, or 70s area that we saw these prior 3 weekly lows. So we know the importance of that support, and now it's matched with that. If we get a move under here, closes the week under here, opens the following week under here, that might suggest we're on for a bigger downside move. You can see we are still in a fairly shallow downtrend for the whole year, well, starting late last year. So the wider picture is mildly bearish while we're in this downtrend. But when you come into the shorter term stuff, as you know, there's plenty to trade in between. We've got plenty of zones, supports, resistance. So there's plenty of money to be made if you want to be trading the levels in between. But now and again, just flick out to the wider charts and see what the wider trends are doing, because that just gives you a little bit of bias, shall we say. You know, you might be more of a rally seller than a dip buyer while we're in that downtrend. But yeah, at the moment, not going anywhere really fast right now, but that's your key support really down here. No doubt we'll see a little bit coming into here. If that holds, then that'll be protecting those lows there, and then maybe we'll have a little waffle around following the data and whatnot. Euro sterling, I'm still short a bit in this one, still holding the line up at the 85s. I'm just round about break even on the average, although I'm a little bit heavier on this one than I am on the 61s part. But here we are. We had a little dip underneath the bottom of the zone here. We're holding it at the moment. So this one's still not out of the woods, still 85s, 84s. That's your range for now. You can trade in between or look to go with the breaks. With the UK elections coming up, that's why I'm keeping my short here. If we get a nice solid majority government, that should calm markets. And if France is a mess by the end of this weekend, we could see some flows out of Europe into the UK, just on political stability more than anything else, which should be of benefit to shorts in this pair. So that's one of the reasons why I'm sitting in that one. I've been turfed out my Kiwi longs finally. This one really didn't give any encouragement after this move here. It's been downhill ever since. So I've largely broken even on the trade. I was slicing and dicing up to here. I did add back just below, but 60-50s, I'm gone on that one. So bit of work for not much gain, but I'd rather not lose than lose, come out of it pretty flat. You know, you're not going to go bust if you don't lose money. Kay, do you want to have a little tinkle around?
I was actually going to show the Kiwi as well, because I gave it a go yesterday. But there's it kept around an interesting trend line that I just want to show, and this is the one that I was watching. I thought, oh well, as the new month was starting, I thought, okay, we may have a bit of a go here back into the 61.5. So I gave it a little try long, added a little here, but then through the prior low here, I also left the boat. An interesting one though is that, again, I tried this Euro Kiwi as well, because there was a bit of offers and interest going on just between this 176.80 figure. We rallied above on the weaker Kiwi data and a small revival of the euro, but this has more to do with euro. It's already reversing, so this one I haven't given up on it yet. It's I wouldn't sell it because specifically of the Kiwi strength, but there's still some decent interest rate divergence in between the Kiwi and the euro, and I do think that sooner or later euro could resume a bit of weakness. So this one, I've actually already resold a tiny bit, but nothing worth calling a position. I will look at how it trades if ever we get back up in those high 177s perhaps, but a reversal here and a move back below 176.40-ish would mean that this was just still a correction of this whole move lower, and it's just not holding. Okay, so this one I'm still keeping an eye on. Gold is finally correcting just a tad. We're trading 23.25 right now, but as you can see, still very much flatlining, and all of that despite the steepening of the curve, the higher yields, and what is happening or relatively quiet geopolitics. Of course, they're always simmering under the surface. So this one is still very, very close on my radar. I am watching this with a high sense of interest, as one Suzuki or Kanda would say in Japan. They are watching it with a high sense of nervousness. I'm watching this with a high sense of interest. I've still got only my very small position that I've started at the end of last month or in the middle of last month even. And I'm watching the game. Okay, if we get below 23 somewhere, I'm gonna get interested. And if we start to break above 23.40, 45, I may push some buttons to add. I think this is still one of the metals, one of the instruments that if we would get some weakness filtering through somewhere in the yields markets, which would mean a small economic slowdown somewhere, they may still go this may still go for a walk. So I'm keeping it very, very close at hand, this one. Silver pretty flat lining too. We're still in a bit of a we could call it a bit of a downward channel, but it's really flat. So if it breaks out here above 29.5, it may still flatline. But what is interesting is that all those attempts under 29 have been bought up. So this is still I'd say mildly positive for those having silver, but be careful with this one, because if we see some setback in the yields also due to deeper economic downturns, this one is going to underperform gold, right? Because it's an industrial metal that needs a slowdown, okay, but not an economy that completely falls out of bed. So higher on lower yields, fine, but it cannot go. It shouldn't go paired with a completely economic downturn, because then I reckon silver will severely underperform gold. Okay, everything smooth can go. Everything collapsing, probably no go. And what else? Yep, Swissy, interesting, huh? Interesting. The Swiss keeps on weakening, even versus euro. So I think the market made up somewhere its mind. Also, we have to look at dollar Swiss rather here. Okay, we have broken above this 90-10, 90-20 zone. That's all due to the steepener, the higher yields on the one hand, and also the S&P having cut rates again. It is a real low yielder. Okay, so I'm not going to stand in front of any weakness of the Swiss. I'm actually still a bit long Kiwi Swiss, but it does not look like to be the best instrument right now to have the Kiwi. I may need to leg out into something different, perhaps even sterling Swiss, or so back into sterling Swiss. That may be a better one, since the sterling is holding up relatively well. Well, I would say despite or through the election risk, but it's holding up well. We have been talking about that quite often enough right now, is that sterling doesn't feel any nervousness going into our Thursday's election. Never say never again, but if we wake up on Friday, and I would say especially into next week, with a sterling that's still behaving okay, even stable, I think this one is perhaps worth keeping an eye on again. All right, so I may try to buy a dip in this one. And Rand. Jesus, I more than a few quick scalps I haven't done in it. Yesterday we were talking, should we buy it below 18? I said, let this market try to find its way first, and we rallied bloody nearly 3% since we spoke about it. It's one that I really, with any decent amounts that I missed really. I think the market is telling us exactly what it thinks, and what I've been saying as well. Get the election out of the way, get the announcement out of the way. The problems are still remaining, and that is what the market is doing. Of course, also these yields, right? If your dollar yields are going higher, if as we can see, the stock markets are hesitant, it's still also a risk currency. But I think most of it is like, now we know what. We are not overly convinced that you guys are going to be able to change much to the existing problems, and this is what the dollar rand has been doing ever since yesterday morning opening. I would say it could really be that before long we are going to test the 19, the figure again on the dollar rand. Yeah, Brand missed the cable. There's two things we could say here. Either yesterday we with this top forming, we couldn't break above 127.20. We formed a new little channel to the downside, but it's just a couple of lines. I'm not sure that we have to look at it this way. I still think that prior lows around 126 are holding. And yeah, Michael, okay. And for as long as we are below those levels here, 125.90 or so, I'm going to try and defend my cable longs. They are smaller, and as I've been saying, and people in the room know, I've been trading it around. Goes up, take some profit. When it goes down, reload. So my average is pretty cool on that one. So I can suffer it a little bit like Ryan on with his Kiwi, but I won't hold it really if we start to move below perhaps 125.90, max 125.80. It's probably telling us that the dollar is still having its wrecking ball moment, and I'm just going out of safety and being conservative with my account, probably let it go. But for as long as this yo-yo continues, happy days. And I'll sell again up in the higher 126s and wait for it either to break or up or down. Dollar mix still bid, Michael. Let's see if we can in the short. Let's see if I can. I'm always hesitant to start putting trend lines in when we only have like certain moves. So let's say this bigger move that we had. We stopped ahead of like a big level here. Then we started to move back up. Then last week we stopped just ahead of the 18, right? And it's still holding up. Now I think what is going to be important here is if we consolidate this move, we could say that something like this, for instance. But I do think here your 1850s are going to be relatively important again. If we start to break above, hold, get that spike out, then we move back up to 19s, okay? I haven't really heard anything specific about the Mexican politics right now. Haven't really looked it up. I don't know how close or far away they are from putting new rules and regulations in place, but I think the market is still on its toes, and they know that it should, in theory, not be very good for investors. So I'd say for now, for as long as this holds, that 1835.40 is perhaps a bit close, but already look at 1835 and then look back at 1820. Okay, 1820 is actually a pretty interesting one in between prior high, prior low. Yep, 1820 is going to be a level. If it goes below 1820, Michael, because I think you're still a bit long, if it goes below 1820, give it a thought and see why it gets below there. All right, and that closes the votes for me today, Ryan.
Thanks, mate. Keep that on there because you take it.
Yeah. Okay, I'm taking it back.
Yeah, you got it.
All right.
No, just we're talking about this dollar strength today, and you know, what is it? Is it this? Is it that? Is it the other? Okay, so we got two pairs here: dollar mex, dollar rand. Okay, both at 1850. Big levels on both. These are the levels that make and potentially make the deciding factor for these dollar moves. If this dollar move is something big, then it will carve through these levels. Okay, if it can't, that tells you that whatever's going on in the market isn't perhaps something that's sustainable for a great length of time, because as soon as you hit a big level, it runs into trouble. So this is what you need to look at. These sorts of levels, be it here, be it on euro dollar, be it on cable, whatever. You pick your big levels where the market time and time again can't get past. And if this move is something, it will take that level out. If it's not something, it will hold that level. And that's what gives you your conviction to trade it. So, 1850 here in dollar MEX, 1850 in dollar rand. If we hold there, then it keeps it in the range, and you know what to do with it. You know what to do with longs. And if you're not long and you fancy a short, you know where to lean against, and you know where you're going to be wrong. You don't have to be wrong for hundreds of pips over those levels. And that's the final lesson for today. Don't forget, if you take a TFP account, you will get some one-on-one time with Blake. He'll get that set up for you. So check that out. It's a nice little boosty bonus. And you can tell him how great the flow show is, and while you're having that chat. And on that note, we shall call it a day for today. Have a good one, everybody. Trade safe, trade well, and we'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.